Hi, dreamers. Today I wanted to talk to you about small cap stocks, and I think we have a pretty big opportunity in front of us for small cap in 2024. And you can see in this recent Motley Fool article all about small cap stocks. The Russell 2000 companies have a net debt to EBITDA ratio of 3.2 compared to with an average of 1.6 for the S&P. And in layman's terms, what that means is that the debt servicing is a big deal for these small companies, and that according to FactSet, only 55% of the Russell 2000 have a fixed rate debt, as compared to 91% for the S&P 500. And so interest rates are a very big deal for the small cap stocks. And that because of this, the Russell 2000 could surge roughly 50% next year alone. And that although a 50% gain for the Russell 2000 might seem extreme, that investors need to understand that small cap stocks are starting the year at very, very low valuations, and that in fact, the S&P Small Cap 600, which is another index for tracking small cap stocks, is currently at a PE ratio of 15.1, which is well below the average for the last decade and much cheaper than the forward PE of 19.8 for the S&P 500. And there's a similar Kiplinger's article where they essentially talk about the fact that the S&P had a pretty nice rally already, not to be outdone by the NASDAQ, which delivered a total return of 40% in 2023, but that the Russell 2000 is still relatively cheap, and that the rate cuts in 2024, which could be up to 6 cuts in total, might propel these small cap stocks significantly. And in this article, it goes on to show some of their top-rated small-cap stocks to consider. But the way I'm thinking about it is that's just going to be a lot of work and a lot of betting on very small tickers, which could take a ton of time to research and even more time to maintain. And so the way I'm thinking about this is actually going down the route of ETFs to look for a basket that would be easier to buy and hold and monitor over the next year. And so what I've done here is put together a handful of broad-based small-cap ETFs for you to consider. And you'll see I've got the ticker, when the funds started, the expense ratio, the number of years of consecutive dividend payouts, the number of years in consecutive growth for the dividend, current yield, whether or not it pays out quarterly or monthly, the 10-year beta, 5-year CAGR, 10-year CAGR, the category of cap, Morningstar rating, and a brief description. So starting out, we've got IWM, which started in 2000, has a pretty average expense ratio of 0.19, a good number of years of consecutive dividend payouts of 23, 3 years of growth, a yield of 1.35, a beta of 1.16, a 5-year CAGR of 7.56, and a 10-year CAGR of 6.69. And this Morningstar rating is only a 2, kind of surprisingly. And the way to think about IWM is that essentially it's just the Russell 2000 index. And the next two are other indices that follow the Russell 2000 pretty closely. You've got SCHA, which has a little lower expense ratio, but also a lower number of consecutive dividend payout years. And then there's IJR, with a higher expense ratio, but also a higher Morningstar rating. The last three are kind of interesting because VB is a Vanguard product with also a very low expense ratio and 19 years of consecutive dividend payouts. But then Vanguard also has a small cap value play, which has a pretty low expense ratio and a little bit of a higher yield at 2.16. And then there's another one we'll take a look at, which is really kind of interesting, CALF, which is also a small value play at a 1.18 yield, but does not have that great of a payout history, but a 5-star rating for Morningstar. So let's take a look at this basket of stocks in terms of performance. So starting out with SCHA, you can see that a growth of $10,000 with dividends reinvested over the last 4 years would have netted you a total return of about 29.62%, as compared to just the regular Russell 2000 index fund of IWM of about 25%. So not that different. If we take a look at IJR over the same time period, it does a little bit better at 34.2% over that 25% for IWM. And VB, the Vanguard product, is a about the same at 34.37. But what's interesting is when we take a look at the small cap value products of VBR, which returned 41.15%, and then this weird one of CALF, which returned just over 81% over the same time frame. And so if we take a closer look at VBR, which is the Vanguard Small Cap Value ETF, you'll notice that 4-star Morningstar rating. And then you'll also notice their top 10 holdings of Buildings First Source, Bunge Global, Booz Allen Hamilton, Reliance Steel, etc., with very small percentages in each, with industrials as the top sector exposure, followed by financials and consumer discretionary. And inside of that, 9% banks, 5% insurance, 5% machinery, etc. And if you want to see the full holdings, you can click here to view all 838, which shows you how broad this basket of stocks is. But then if we go over to CALF, which is the Pacer US Small Cap Cash Cows 100 ETF, you'll notice quite a different strategy, with the top 10 holdings being 20% of the holdings, each at about 2%. And you'll notice that this basket is only 100 holdings. So what's going on with this one? Well, this is usually when I go to Seeking Alpha to see what else I can learn about CALF and what the rankings are. And here you can see this article, Small Cap Investing with a Value Tilt. And essentially you can see here that the CALF ETF strategy is to screen the S&P 600 index for the top 100 companies based on projected free cash flow and earnings over the next 2 fiscal years. And you can also see that financial companies and REITs are excluded. Now, one of the drawbacks I noticed in CALF is just their history of dividends. And here, if I click on dividend history, you can really see how those payouts were extremely inconsistent. And so that's a big negative in my mind. Whereas if you go to VBR, the Vanguard Small Cap Value Index Fund, you can see a fairly consistent payout history for them, with the biggest payouts in the fourth quarter of every single year. And so if you chart all of these inside of Seeking Alpha, you can see the Russell 2000 Index, IWM, at a 47% total return, with the next one being IJR at 53.6%, then SCHA at 54%, followed by VB at 63.15%, VBR at 63.49%, and then CALF at just over 102%. Now, the only other thing I wanted to show you here is just if you're an options trader like I am, you probably already know that IWM has significant volume in the trades, which you can see here just captured from today. And so based on all of that data, which ones am I likely to invest in to capture the upside potential in 2024? Well, I'm probably going to build to 100 shares in IWM just to take advantage of the broadest basket of Russell 2000 plus the options potential. And so that's a yes for me. Since SCHA is so incredibly similar to IWM, I probably will leave that off the table in order to put more money into IWM. Now, IJR did a little bit better, but since it has a higher expense ratio, and it pretty much is the Russell 2000 again, I probably will favor IWM in order to consolidate to be able to get to that 100 shares. And for the same reason, I probably wouldn't put into VB, because it's just too similar in terms of performance to the other broad-based ETFs, which leaves us with the small value of VBR and CALF. And I might put just a little bit of money into VBR, as it had better performance, a good expense ratio, a reliable dividend payout history, a pretty good dividend yield, and overall probably the best of all worlds in terms of safety, broad holdings, and yield. And then this one is a maybe for me, and I might just put some money in there as an experiment and a test, since you know that I like to buy one share and monitor for a little while. This might be the more experimental one for me. And so those are my small cap ETF picks. I'm curious what small cap stocks and ETFs you're interested in and doing research on. Feel free to let me know in the comments. Well, that's it for today. I hope you enjoyed this dividend income update. And if you want a richer, real-time experience with me, you can always follow me on Instagram or X. And if you're doing your own research using Seeking Alpha, feel free to find the link below to subscribe if you want, no pressure. As always, I encourage you to do your own research, then implement and learn by putting it into practice. And as a reminder, I'm not a financial advisor, so keep in mind these videos are for entertainment and inspiration only. I'll see you on the flip side.